You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth.
Hello, I'm Deidre Woollard, an editor at Millionacres, and thank you so much for tuning in to the Millionacres Podcast. Really excited to share the journeys of today's guests because they have experience in so many areas of real estate investing. Julie Lamb and Annie Dickerson are the founders of Good Egg Investments, and they both have over a decade of investing in real estate, including multifamily buy and hold rentals, private lending, and passive investing through real estate syndications. Together, they've created the Real Estate Accelerator mentorship program, and they're the authors of the book Investing for Good: How to Build Wealth While Also Making an Impact. Welcome to both of you.
Thank you so much for having us. We're thrilled to be here with you and your listeners.
Let's talk about the title of your book, Investing for Good: How to Build Wealth While Also Making an Impact, because that really appeals to me. Why is that? Why does that also appeal to you, and why does impact investing matter?
I think as women and as moms, our priority is on leaving the world a better place than we found it. And that's through everything that we do, through raising our kids, through our jobs, and through how we spend and invest our money. And so when we discovered that we could invest in real estate and not just have an impact on a single rental home, but have an impact on a whole community, because often we're investing in these larger assets that are, 200, 300 units, we realized, hey, we can make a great return on our money, put our money to work for us, and also make an impact in the world. And so that's when we were hooked.
I love that. The two of you, you're both entrepreneurs. How did you meet, and how did you both discover that you shared this interest in real estate investing?
Well, let's see. So we met a few years ago now at a real estate investing conference. And if you've ever been to one of those, you would know there are very few women. So it's one of the very few places in the world where, you go to a place and the line out the men's room is longer than the line out the women's room. So it was a very fascinating thing. And so Julie and I, not only were we both women, but we were both Asian women. And so we really hit it off at that conference. We were both moms, working moms, and we wanted to start a business to help other people invest in real estate. And at the time when we met, Julie already had her business. And I had just literally quit my job the week before, and I was getting into it. We hit it off. We didn't think about forming a partnership. We were just like, hey, let's stay in touch. And in the months following, we started to have more and more conversations. And through that, we realized we had very complementary skill sets, and we were trying to help the same people, namely busy moms and parents, to build passive income for their families. So we said, hey, why not just join forces and we can go farther faster?
So what were you doing before you started your business?
Well, for me, I had started out as an elementary school teacher and then worked through, I then transitioned to get into educational games and then got into instructional design, creating corporate training for companies. So that was the last thing that I did before this curveball life threw at me, which was real estate investing. So I was a creative director in the learning and development space.
Yeah. And this is Julie speaking. And I worked in the legal field for probably the last 10 to 15 years before I got into real estate. On the admin side, was not an attorney, went to law school for a year and quickly realized within the first year that the ROT, I guess the return on my time, wasn't there for me, and didn't continue to pursue it. But that's what I was doing.
And how did you both find real estate? Because obviously you were both in real estate before you met. So what was that journey like for you first, Julie?
Yeah, so I started investing in 2009, and it was a great time to get in just because the market was way down here in the San Francisco Bay Area. And I was just doing the traditional, you're taught to get married and buy a home. That's how we're taught to grow our wealth. And so that's what we were setting out to do, my husband and I, or fiance at the time. And we realized through that purchase, that initial purchase, that maybe we could do this more of this because we had bought it at such a discount. And so we bought that first property and then we bought a second property. And as the market cycle started to mature, we started to see that equity come back that was once there like a year or two before. And then it became a question of, okay, well, what is the next thing that we could do with this money that would allow us to have it work as hard as possible with the least amount of risk that would serve us in our lives today? And that's what led me to getting into out of state investing, which then eventually led to multifamily investing or multi unit investing, and then led us to what we do now.
And as for me, let's see, actually, Julie and I have a very similar sort of parallel background with real estate. We started with duplexes, my husband and I, and we house hacked those. So we lived in one unit, we rented out the other. We were living in Washington, D.C. at the time. And so we bought a couple of those duplexes. We named them after letters of the alphabet, Alpha and Bravo, and thinking that we would collect all the letters of the alphabet in our lifetime. And so we set about that trajectory. So we collected Alpha and Bravo in DC. Now we live in Oakland, California. So we bought Charlie and Delta. And then Echo was the first time that we invested out of state. And the first time that we did a total like rental property that we did not live in or house hack. And so we invested in Huntsville, Alabama, and we did Echo and Fox. I'm forgetting my letters of the alphabet. Echo, Foxtrot, Golf. And we quickly realized, and this is where I think this is really relevant to your listeners, is we quickly realized that investing in rental properties, especially out of state, even when you have a good team, which we had a fantastic property management team, it still can be a lot of work as a landlord because you still have to manage the asset. You still have to make those key decisions. And so I remember this one time, my property manager calls me out of the blue. And she's like, okay, are you sitting down? I'm like, oh, this is not going to be good. And she's like, well, those tenants we were going to evict tomorrow because they hadn't been paying for months. And I said, yes. And she said, well, you're going to want to sit down because what happened was she stopped up all of the sinks and the tubs in the unit. And she flooded not just that unit, but it was a fourplex. So she said, well, she flooded that unit and the one next door and the one next door to that. So 3 out of the 4 units were offline for that entire summer. And so here I was, busy mom. I've got all the, the carpool, the kids' activities. And on the side, I've got to be calling insurance companies and filling out paperwork. And that was when it really hit home for me that at this stage in my life where my focus is on parenting and raising my kids and growing our business, that passive real estate investing is really a better fit for me and for us at this point in our lives.
That is really interesting because on our Million Acres team, we have a bunch of people of differing ages, and 2 of the investors on our team both have young kids, and they both had Airbnb rentals for a while, and both of them are now at that stage where they're like, maybe this isn't going to work for me when I've got a toddler running around, and I want to have a different kind of lifestyle than I wanted to have 10 years ago. So that makes a lot of sense. What's it like to kind of take that leap, and how does an investor get started going from single properties to real estate syndication?
I would say the first thing that somebody needs to do, and this is what I did, was I spent a ton of time just educating myself, just because it's pretty complex, but there's a lot of resources out there now. 4 years ago, there weren't, but nowadays there's a lot of free resources out there to kind of help you break down what syndication is, what apartment investing is, and how it all works, the terminology and all of that. But I would say that that's really the first thing that you want to do. What you don't want to do is find a deal or start getting your email inbox stuffed full of opportunities and just dive right into looking at a deal and seeing if the deal makes sense, from your perspective, because it'll be I think really difficult to understand the risks that are presented in these deals, and there are risks without really understanding exactly what it is that you're getting into. And so I spent probably a good 8 months or so, really trying to educate myself, trying to understand who the players were in the space, what made a good market, what made a good deal, what made a good team, and then started, putting deals in my inbox by networking and letting people know I was looking for opportunities, and then kind of doing like a trial run and just, looking at the opportunities and doing my underwriting and my own underwriting. And that's something else that I think, even as a passive investor up front, you should know on a very high level how to do underwriting and what that means. And then looking at the opportunities and seeing what are the differences between the two, and really, trying to distill down for yourself what are the important things for you, because for every investor it's going to be different. Maybe for you it's cash flow, maybe you're not so interested in taking on a lot of risk, maybe you want something that's nicer. There's a lot of different things, and you get a feel for that as you start to look at more deals. And so really, I recommend anybody who wants to get into this space spend a good amount of time up front, because trust me, it'll pay off dividends down the road and really help it become what we call a passive investment after you spend that time up front to do that work in that due diligence now.
So, do you have to be an accredited investor in order to participate in these types of deals?
No, you don't. So it really depends. There's different types of offerings. Without getting into too much legal jargon, there's basically two types of offerings. There's one that's a 506B offering, and those offerings allow you as a sophisticated. So either way, you still have to be sophisticated, whether you're non-accredited or not, but that'll allow you to come in as a non-accredited sophisticated investor. And usually there's a cap. I think it's around 30 to 35 people that can go into any one deal as a non-accredited investor. But for the most part, they're only open to accredited investors. Then there's another section or offering type that's 506C. And if it's a 506C offering, then yes, you would need to be accredited, and those do not allow any sophisticated non-accredited investors.
I think the main thing that listeners should be aware of as it relates to accredited versus non-accredited is, if you're accredited, you can pretty much, the doors are open for you. You can pretty much invest in any type of these syndication deals. For non-accredited investors who are interested in these types of deals, you should know that the deals that are open to non-accredited investors cannot be publicly advertised. So you're going to have to do a little bit more work, a little bit more digging, and that networking that Julie was talking about. You're going to have to talk to more people, because you're going to have to form those relationships with the sponsors or the operators on the deal in order to get a spot in the deal, because they cannot be publicly advertised.
That's a really good point. And then, of course, when you're looking at these syndications, like Julie said, it's hard to know what you're looking for starting off with. How big a factor is trust then for individuals as they're first getting started and trying to figure out what deal is right for them?
Oh man, trust is everything. Trust is everything.
It
I
is.
mean, anybody, when you start looking at these investment summaries for these syndication deals, it's super easy to get lost in the beautiful photos and the numbers, and anybody can get swept up in that. And the truth of the matter is, yes, it's really fun to look at all that stuff. But when the deal closes and the rubber meets the road and the operator actually has to perform and actually execute on that business plan, that's where you really need to trust that team. Because as a passive investor, you're not going to be the boots on the ground. You're not going to see that property day in and day out. You're not going to be renovating and making those calls and hearing from the residents. You're not going to be on the front lines. So you really have to be able to trust the people who are the stewards of your investment. And so that's why, as Julie was saying, it's so important to form those relationships and really educate yourself up front, so you even know how to form that trust and what questions you need to ask to vet those
Mhm.
operators.
And I just would add on top of that, that in order to form that trust, how I did in the beginning was really to build a relationship as much as I could without taking up too much of their time. And one of the ways that I was able to do that was if they have a podcast out there or if they frequently appear on podcasts, listen to all of the podcasts because that's going to give you a really good feeling for the types of questions that they ask, how they respond to those questions, and it'll give you an opportunity almost to kind of get to know them. And I spent months listening to the person that I ended up investing with first, listening to their podcast and listening to, just the questions they were asking, like I was saying. And I think that's such a great way to get to know somebody without having to say, hey, can we hop on a call? I'd love to tap your brain for the next hour or two. And, them saying, well, maybe or maybe not. But that's also another thing though, too, is, if you're interested in working with a group and you have a bunch of questions for them, and either they ignore your email or and don't respond, or they reply to like a list of 10 questions with a one liner, that's a sign. And it was for me, because there were a lot of people out there who did do that in the beginning and I didn't get a response. And then, a week later they would circle back and ask if I was interested in investing. So a lot of it, I would say a lot of it is just, intuition too, learning to kind of trust your gut and, does this feel right or not? Asking all the questions you have, because if they're interested in developing a relationship with you, then they're going to put in the time versus are they just interested in taking money from you?
That is really good advice. So let's talk a little bit about your business. Good Egg Investments has two different arms. You've got your investing side and you've got your education side. So let's start with the investing side and tell me a little bit about how that works.
Yeah, so when somebody is interested in investing, kind of like running through the process that we were just talking about, we have many different avenues for people to kind of get to know us. And that's really what we encourage people to do. That's what I'm here talking about as well. But, it would be to go get yourself educated. We have a ton of resources on our site. Learn about what it is that we do, hear about us, listen to us on podcasts, get to know us, and then once you're, at the point where you think you're ready to engage in a conversation with us, sign up for our what we call our investor club. And once you sign up for that, then you start to go down sort of a path of more education. Again, getting to know us. Who are we? What is our background? And then you jump on a phone call with us and then you learn a little bit more about us. We get to learn about you more importantly on that initial call. And we don't always have to do that with the 506c deals. We don't have to always have that pre-existing relationship, but we want to know who you are and we want to know that you guys are a good fit for us. And so that's kind of the process there. And then once you're on our list, then you start to see deals. And this is typical, by the way, for most operators out there. This is kind of a similar process that you would go through. And then once you get through that initial vetting process, so to speak, on both of our ends, you would be privy to see any opportunities that we have. And then once you see the opportunities, then it becomes a question of, is this the right one for me? Which is not something that we can advise you on, but is a decision that you would have to make on your own. Given your goals, we can talk about the deal specifics, but we can't talk about whether this is a good fit for you. But that's kind of the process in a nutshell. Once you've identified an investment opportunity, then it becomes, a matter of whether you're really seriously interested or you're just kind of checking things out. And once you say you're really interested in investing, then it becomes a matter of reviewing legal documents and funding. And that window from the time we announce a deal to the time funding happens is usually about 30 days. And then it's about another 30 days to close. And then it's another 30 days till your first distribution. So, all in all, it's about a 3-month window from the time you hear about it to the time you get your first distribution. But that's kind of in a very high level what happens in the process.
And what I would add to that is, on the business end and the in behind the scenes, if you will, what happens is, so The reason why Good Egg Investments is sort of unique is that over the last 3 years, we've done over 25 of these real estate syndication deals. And we've been able to partner with excellent sponsors in really great markets, Dallas and the Southeast, Florida, all the Carolinas, all of these great growing markets with excellent job growth. And what we do is we know it's hard to find these types of opportunities. I mean, if you type into Google real estate syndication, it's going to take some digging to really find, okay, who are the good operators and where are the good deals? What are the good markets? There's a lot of work that needs to be done there. And so what we do on behalf of our investors is we are in the know. We're networking with people all the time. And so we are in this space. So what we do is we sort of look across the industry and surface the cream of the crop of those opportunities. And that's what we present to our investors.
Excellent. Thank you. Well, I looked at your portfolio on your website and I saw a lot of things in Sunbelt cities. Part of our investing thesis on Million Acres, we've been really noticing multifamily in the Sunbelt seems to be, a place where there's just so much opportunity, there's so much migration, increase in jobs. How has that strategy been working for you? And how did you sort of decide that that was one direction that you wanted to go in?
Yeah, I mean, I think it's been a great strategy for us. We did our first deal 4 years ago, and we're just exiting those early deals that we did earlier on, and returning a good return for investors. And so I think initially why we decided to invest in those areas is really because we're looking at. It really boils down to one thing, and and then a number of things happen after that. But really, it boils down to are these states business friendly states? Because if they are, what's going to happen is all of the corporations are going to create jobs in those business friendly states. And then as a result of that, what's going to happen are people are going to move there for those jobs. And so then what ends up happening as a result of that is that it drives demand for affordable housing in those areas. And that's exactly the space that we're playing in is we're looking at these affordable housing type of units. So most of the time we're not going after high end A class, what we call A class luxury product. We're really going after what we call workforce housing. And so it goes back to, supply and demand. And so if there's a lot of demand from all of the population growth in these areas where there's limited supply because you can't build something that's an older product, then that's kind of been our philosophy. But a lot has changed since we first got into this space 4 years ago. We were at a different point in the market cycle, and so there was more room at the time to take on a little bit more risk, where we would do what we call value add deals, where we're going in and we're making improvements. It's kind of like a fix and flip. This is the way we did it. But right now, there's a lot of uncertainty with all kinds of things going on. And so we've kind of shifted a little bit and we're really looking at not necessarily the top tier luxury stuff, but we're looking at more of things that can be a nice solid buy and hold with not a lot of like deferred maintenance and things that would cost a lot of money over the hold period. So it's kind of evolved over time. But as far as where we're investing, we're still focused on those same Sunbelt states. So yeah.
Yeah, I think workforce housing is absolutely where it's at. It's definitely something that we've been looking at too because there's so much demand and it seems like there's a bit too much supply maybe on the luxury sides, certainly in major cities right now. So I think that's a concern for a lot of investors. Well, you guys are both based in the Bay Area, San Francisco. What are you thinking of that market right now? I mean, we saw rents drop dramatically last year. Looks like they're starting to tick back up again. Is there any window for investing, do you think, in San Francisco and in Oakland?
Well, I think it depends what you're investing for. So if you're investing for cash flow, then this is probably one of the last places that you would want to invest because you would be lucky if you could break even with after mortgage and expenses. here in the Bay Area. But that being said, there are people who do it. And there's a ton of potential appreciation. Some people do get a little cash flow if you're a little creative, but it's a little bit riskier on the cash flow front. For the appreciation, again, that's not something that's happening today. That's something you've got to wait it out and see over time. But there are a lot of people who still believe in the potential of this market. And so they're investing here, not for the cash flow today, but for the appreciation down the road. And so if that is what you're looking for, then I'd say that the Bay Area could very well be a good place to invest.
Yeah, and I would just add on top of that I think it's really, dependent on what your investing style is, what your comfort level is, what within the real estate investing world, there's so many different things, right? I mean, it's not just apartment syndication and rental properties, right? You can, you can do flips, which I know a lot of people in the Bay Area make hundreds of thousands of dollars on flips here, just because the price of homes are so high. Other people I know are into zoning, right? Where they buy a piece of land and they research the zoning and they go ahead and make zoning changes and then they flip it and they sell the land to a developer. So there's lots of investing happening here in the Bay Area for sure. I think it just really depends on what your goal is, and specifically tied to what we do, investing for cash flow and financial freedom and life by design and all of these kinds of things probably wouldn't be a good fit anytime soon. So yeah, I think it's really relative on what your goals are, like Annie was saying.
Yeah, it makes sense. One thing that I've seen my friends that are up in the Bay Area do is adding ADUs as a way to increase income if they're buying a property.
Got a small lot, you got to add every bit of space that you can. Got to get really creative.
Exactly. Awesome. Well, this is a great place to take a short break.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material. And it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. All right, I am back with Julie Lamb and Annie Dickerson of Good Egg Investments. Let's talk a little bit about the other part of your business, which is your Real Estate Accelerator program. Why do you think it's important to learn how to raise capital?
Well, specifically, our Real Estate Accelerator program is geared toward people who don't want to be passive. They want to be active. They want to roll up their sleeves and they want to do a syndication deal of their own. Now, what we see most newer syndicators do is they'll say, okay, I want to syndicate a deal. And okay, so I've got to talk to brokers. I've got to figure out how to do the underwriting. I've got to find a market and a property manager. And they go through all of those acquisition steps, right? So they do all this work. They get a deal under contract and they're like, yes, I got one. Now what? And they're like, okay, well, I need, let's say, $1 million to close this property. Okay, surely I can talk to my Uncle Frank and my cousin Bobby and and they go down the list and they're like, surely they'll want to invest with me. I'm a really good person. They know me. And so they start reaching out to their friends and family. The time is ticking because, they may have, 60 days, 90 days to close. So they're in a rush, right? And maybe Uncle Frank, cousin Bobby, whoever have never heard this person talk about real estate before, right? So they're like, what? You're doing real estate now? Well, I don't know. Well, this deal looks okay, but I don't know enough about it right now. So maybe I'll sit this one out and I'll come in on the next one. Right. And so we see this happen all the time. People do all of this work to get a deal under contract, which is not easy. And then they lose the deal because they didn't do the work up front to build up their investor base so that they could raise the capital to close the deal. And so that's why we've focused on that piece in particular, is because building capital is the piece that takes the longest, because as we touched on earlier, you've got to be able to build that trust with your investors, and you've got to have a steady flow of new investors coming in. And so that's what we teach through our program, is not just how to talk to investors, but how to build an entire platform, an entire brand, as we have a movement that people really want to get behind. And that's what's going to take those cold leads and turn them into loyal investors.
Do you feel like it's harder for women to raise money as syndicators? You mentioned before being at that real estate conference and not seeing a lot of other women there. I feel like there's a little bit of a disconnect between women in real estate. You have so many real estate agents that are women, but not as many women on the investing side. Is that something that you've noticed too?
I think it really depends on the approach that you take as a woman. I mean, I think if you go into it thinking that, I think that you're going to find that you have more obstacles. But I don't know that Annie and I ever thought about that we thought, well, we have something against us, because we're women in the space. I think we really went at it. And this is what I see with other women in the space who raise money, and there are a handful of us, is that they really let their passions guide them. And when they let their passions guide them through this space, inevitably they end up having a lot of followers and a lot of interested investors who want to work with them and who trust them. And so I think if there's anybody out there who's a woman who's thinking about getting into this space, I think you need to ask yourself, the question of why are you doing this? Because I know the one single thread that I've seen across every female in the space who's raised money is that they're very, very passionate about what they do and about helping not just their investors, but other women in the space as well. And so I think it really depends on your goals and how you're looking at it. But I don't know that it would be any harder per se. I think it's all in how you frame it, and how you approach it.
And the other thing is, it also comes down to your target audience, because just as there are women syndicators, there are women investors. And so that was one thing we did early on in our business, is we really sat down and we said, okay, who exactly are we trying to help? Is it doctors? Is it engineers? Is it men? Is it women, young, old? And we really sat down and figured out exactly who our investor avatar is. And it's not everyone. We thought it was everyone with money at first, but that wasn't it. We defined it down to a busy working mom living in a city like San Francisco who's has a good job. Her husband has a good job. They're making all this money, but they don't have the time to invest in real estate. And so they're trying to figure out other solutions, and maybe they don't even know about passive investing in syndications. And so how do we then reach them and connect with them? And so when you think about it that way, it almost becomes this fun little challenge. Like, where are those people currently hanging out, and how can I reach them? Not as somebody who's trying to sell them on something, but really as a friend, as somebody who's trying to extend them an opportunity that they might not have access to otherwise. And I think when you think about it that way, it sort of takes the intimidation factor out of it. And I think women, one advantage is that often we're natural teachers. And you need to be a good teacher in this space because there's so much to explain and so much that investors need to understand before they can confidently invest with you. And so it's funny because we have a lot of investors who will come and say, oh man, I invested with this other company before and I thought I understood it, but now I really understand it. And so I think that's also, an advantage to all the education that we offer is that people aren't afraid to approach us and to ask us those deeper questions.
Well, I think that's really you mentioned something really important here, which is communication. And one of the things that I've noticed in looking at various deals on crowdfunding platforms and things like that is the amount of communication between syndicators and developers and the investors themselves can vary quite a bit, and that can be scary for investors. So, what do you feel like is a good communication strategy for syndicators? And can you explain a little bit about what that responsibility is like?
Yeah, I mean, I think that, this goes back to what I was saying early on. Like, you really have to develop that trust with people, and communication in our business is huge, not only with our investors but internally with our team as well. I think it really starts on the front end, and that's the thing that I personally never liked about like crowdfunding sites is I don't ever feel like I have the opportunity to talk directly with the people who are going to be the stewards of my money. It's through a platform, and that worries me. And so I don't know exactly because I've never invested through a platform, but I don't know exactly what the communication is limited to. But I would say that it's huge. Like, if you're the group that you're going to invest with, even on the onset, isn't being responsive to emails, you're going to be in a long term relationship with this group 5 to 7 years sometimes. If it's not like that in the beginning, it's like any other relationship. If it's not good in the beginning, it's likely it's not going to get better when times are tough. So I think, really paying attention to that level of communication, the frequency, the attention to detail in your questions. And then, once you've gotten into a deal and they have the money, are they still responsive to your emails, right? Because that's a big one. Like, they could be just like, okay, I've got your money now on that one deal. Now, okay, on to the next. But really, it's just paying attention, the responsiveness, the rate of responsiveness, and the sense of urgency, I guess you can say. Like, within our team, if one of our investors sends us an email, it's like myself on it, it's another team member on it. We've got a number of people who respond and reply and are available in every communication I send out. I always put my cell phone number at the very bottom so people can call me at any time of the day if they have a concern, right? So I think communication is one of the things that is so important in this business and in life too, like I was saying. But it's something that I think at Good Egg really sets us apart from others is our attention to that piece of it. I just think it's so important.
Well, I really love that you mentioned, not stopping that communication after you get the money, because I feel like, I feel like that happens far too often, and that's really important because
Yes.
like you said, it's a long term hold, 5 to 7 years. That is a long time. It's not a liquid investment. You're putting your money in and you're waiting. So let's talk a little bit about that. How do you prepare people for that idea and for making them really understand, okay, this isn't the stock market. You can't take out your money when you get scared.
Yeah, I mean, I think a lot of it is just about setting the expectations up front and really, and this is what I was talking about in the beginning, like really knowing what you're getting into. Spend the time, because the last thing you want to do is get into an investment and then something happens in your family and it's an illiquid investment, and you call your sponsor and you say, hey, I need to get out, and they say, well, it's an illiquid investment, but what is the situation? So really, I think just like knowing up front, which is why Annie and I are so big on education. It's something that we don't want people to get into deals and not understand what they're doing. And so the education piece up front, before you even hop on a call with us, you will have been given all the pieces of information that we feel are the most important pieces to understanding what a syndication is before we ever hop on a call. But yeah, I would say that it's a lot of it is just about getting that education up front and, framing sort of what it's going to look like once they get into it.
As far as those expectations go, a lot of what we're doing in those early days is we're getting to know potential investors. Is not only are we looking for a good fit for them, like, whether they should invest, but we're looking for reasons that they might not want to invest in these deals. And we're not just going to take anyone and just say, okay, you got 50,000. Okay, let's get you in this deal. We're really looking for that fit because it's going to be a 5 to 7 year hold. And that's going to be a lot of back and forth. And what we don't want is somebody to invest and then regret it the day after, or then say, oh no, I made this huge mistake, or not understand all of the risks. And so that's why we take so much time up front and we say, if this is the only $50,000 you've got, maybe now is not the best time. Maybe you take some time. Here's some other opportunities that you could invest in. If you did want to get into real estate, maybe grow that nest egg a little bit and then come back. And then once you have a little bit more cushion, then that $50,000 becomes more play money. And then you can invest in syndications.
And they don't always like that answer. That's a hard conversation to have, right? Because people are so excited about working with us. Maybe they love, the brand and they want to work with us, or they like the idea of syndication. But at the end of the day, if I was in their shoes, I would be so grateful for somebody to have given me that advice, many years ago, as opposed to saying, sure, come on in, I'll take your $50,000, but really explaining to me why it might not be a good fit or why now might not be the right time. And that's something, again, that I think really sets us apart from other groups, is that, we, at the end of the day, this isn't a job for us. Annie and I left our jobs 3 years ago. We aren't looking for another job. Annie and I do this because we're passionate about it and we really want to help other people. And so, yeah, it's a hard conversation to have, but one that I think is essential. So.
I really love that aspect of caring and responsibility, because someone's money is their future. It is their work. It's more than just a dollar figure. We talked about multifamily and Sunbelts. Is there anything else, any other investment ideas that you're sort of looking at right now? This has been such an odd series of sort of mini cycles within the major real estate cycle we're in. What do you guys kind of have your eye on right now?
I think one of the things that we're really focusing on right now is diversification. Just because there's so much uncertainty right now, and it's not really the time like it was, even 2 years ago or even a year and a half ago, to take on a lot of risk. And so, as I mentioned, we're kind of moving away from the value add opportunities, and we're really looking at potentially building out a fund. So that's something that we have on the table for this year. And a fund, what it is it basically is a collection of various investment opportunities that will allow investors to not just invest 100,000 into one asset, but it'll allow them to invest in 5 to 7 different assets, sometimes across different strategies as well. So in the fund, there could be a nicer A class property with no value add, and then maybe that fund structure will allow us to have a little bit more risk in something like a value add or a B class deal. And so looking at funds is something that we're personally looking for our own portfolios, and as a way for us to still generate returns, but hedge sort of all of the craziness with everything that's going on right now. That, as well as different asset classes. So, not just diversification amongst multifamily opportunities, but also diversification across different asset classes. Self storage and mobile home parks is something else that we're looking into. But those things take time to kind of build those relationships and get a feel for what's happening in those spaces as well. But those are some things that we have coming down the pipeline. So, yeah.
Interesting. Mobile homes is something that I'm looking at as well. It seems, and we've some like Blackstone is making deals in mobile homes, which anytime Blackstone does something, I'm like, okay, what's coming next? So definitely something to kind of keep an eye on.
Yeah.
I wanted to bring up this other thing because I noticed on your blog you had a post on whole life insurance. I interviewed another syndicator recently, and he talked about it. I'm really curious about how this works, and I think it's something a lot of people don't understand. So, can we discuss that a little bit?
Yeah. Oh my goodness. This is one of our favorite topics that we've talked about many times on our podcast as well. It's something that Annie and I both do as well. I wouldn't say that I'm the best person to explain it in absolute detail, uh, but on a very high level, the way that Annie and I use it is really as an alternate banking strategy. That's kind of the way that we look at it. And the way that it works is you buy what they call whole life insurance policy, meaning that it's good for your whole life. And you pay a certain cash, a premium, excuse me, to have a certain cash value build as the years go on for your whole life, basically. And it's so flexible in the way that you can set it up. And really, the reason that we do it is because within the policy, you're able to build that cash value. And as your cash value grows, you're also collecting a return or an interest on that money as well, somewhere usually between 3 to 7%. It just depends. And you can actually take loans against the policy. So as your cash value begins to stack and build over the years, as it will, you can pull out a loan to then reinvest into real estate, and that's how Annie and I use it. And then once we reinvest, now an investment that had an 8% return or a 7% return now becomes a 10% return because of the additional interest that you're getting within the cash value in the policy. But one of the cool things that I did is that I started a policy, and then I took a loan against the policy, and then I took that money and invested it into a single family home that then pays the cash flow from the single family home, then pays for the policy premiums for the time that I have it. So it's actually not me paying for the policy premiums, but it's actually my renter who's paying for it. So that's kind of a unique little, workaround. As anyone who's digging into this, ask your advisor who's putting the policy together for you to, for advice that way. Because and that's another thing I would say too, is make sure that the person that you're hiring is aware of the what they call infinite banking approach or strategy, because how you set up these policies is everything. If you set it up the wrong way, in a way that's not made for this approach or the infinite banking strategy, it's not going to have all of the benefits that it could otherwise have, with the exponential cash value growing over the years and things like that. But that's in a nutshell the best way that I could explain it. But there's certainly some info on our website as well about how it works. But yeah, Annie, you have anything to stack on top of that?
Nope, just kidding. You did great. You did great. I always get tied in knots when I tried to explain this, because like Julie said, we both use these policies ourselves. But then it's funny when I try to go explain it to people, I'm like, oh, how does it work again? But what I would add is that not only do Julie and I have these policies for ourselves and our spouses, but we also have them for our kids. So it's never too early to start start. And so we're building up these cash flow life insurance policies, whole life insurance policies for our kids as well. And so we're getting them a head start on building that equity over their lifetime.
That's fantastic. Thank you both for that. So, as we wrap up, wanted to ask you if there are any books you'd recommend or any other podcasts other than your own that have inspired you and might be good for investors to check out.
I have two books that I love recommending. I read them at perfect times in my own real estate journey, and they made such a big impact on me. One was Building a Story Brand, and that one is more for entrepreneurs. And that one, it's by Donald Miller, Building a Story Brand, or it might be How to Build a Story Brand. But what he talks about is how most entrepreneurs, when they're building their brand, they are focused on themselves. And so they say, well, we do this and we do that, and we can help you with this, right? But the truth of the matter is your customer, or in this case, your investor, they want to know what's in it for them. And they want to be the hero of the story. So, in fact, the entrepreneur, your business is not the hero of the story. You are the guide, or in the Star Wars analogy, you are the Yoda to your investors, Luke Skywalker. And so that really shifted our whole perspective on how we were building our business. And then the other book that I love to recommend is Emerging Real Estate Markets by Dave Lindahl. And this is more for either the active real estate investor or even somebody who's looking to get into passive investing and trying to learn about different markets. Because this is something that holds up a lot of investors when they're looking at different markets. That's one of the hardest things, because when you look at a map of the United States and you're like, well, where do I start? I don't know. Do I just throw a dart at the map? And do I go with where I grew up or where I'm living now? And so that book, Emerging Real Estate Markets, really gives you a good idea of the fundamentals to look for in potential markets, whether they're emerging or they're already established. But things like job growth, population growth, job diversity, and a whole lot more. So that one's a great one as well.
Yeah, and I would just stack on top of that one of the books that I'm sure a guest or two probably has already mentioned on the show, but I'll go ahead and say it anyway because it was such a game changer for me and my husband, was Kiyosaki's Rich Dad Poor Dad. And I know it's one that so many people talk about, but for me, and I think for most people out there, trying to understand the mindset shift that you need to have to go from the traditional, go to college, get a job, buy a house, work for 30 years. It takes something to really kind of jolt you out of that, and Rich Dad Poor Dad does such an amazing job at that. And so that was really a game changer for me and my husband back when I told him that we were going to quit our jobs and be retired in 5 years. And here we are 5 years later, and we've both accomplished that. But it was really having him listen to that book. So that was a good one. And then as far as podcasts go, one of the ones that I used to listen to all the time is the Bigger Pockets podcast. And so they've got a number of different offshoots as well, not just the main Bigger Pockets podcast, but I used to commute 2 to 3 hours a day, 5 days a week. It was a lot of fun. And back in those days, I miss those days actually, because it was the time that I had to myself, and it was a time that I was able to listen to podcasts for hours on end. Now I don't have that time. I don't commute anymore. But learned so much from that podcast, just about if you're just kind of getting into real estate and you're trying to figure out where do I fit in, that one was such a good one for me. And it's real casual banter. And it's good. Lots of good information. And yeah, I think it was really those two. I'm trying to think if there's another one. I know Bigger Pockets also has a lot of books. So if you go to biggerpockets.com, I know that there's a ton of books that people on their site have authored on all kinds of different things. I know Jay Scott is one of their popular authors, and he's written a couple of books. One that I'm reading right now, actually, on how to invest in any economy, and that's so helpful for where we're at right now to really understand the different phases of the economy, and where we're at, and how to thrive no matter whether we're at the top or the bottom. So that's another actually good book I should have mentioned. But they've got a ton of great books on their site as well. So yeah.
Can I add one more?
Absolutely.
I thought of one more, especially for listeners with kids, is Rich Dad, Poor Dad's kids version. They actually have a graphic novel version of Rich Dad, Poor Dad. I believe it's called Escape the Rat Race. And I read it. I read through it with my older son last year. He was 7 at the time. And we've been trying to teach him these principles for years, like saving and investing and giving, and and he just didn't really get it. But after we read that book, the first thing he did after we closed the cover on that book is he went over to where he keeps his money, and he took all the money out of the spend jar and he put it in the save jar. And he was like, I get it now. I understand it now. I'm like, yes. So that's a great one for any listeners with kids or who want to take a shortcut and just not read the full book. You can read the graphic novel version.
I love that. And I love the idea of teaching your kids young. I think that's so important. I think so many people forget that. Financial literacy is one of the things we talk about a lot at the Motley Fool. And it starts so young like that.
Yeah, because most kids, their money habits are formed by the time they're 7, which is so scary. But it's also exciting because you have that opportunity to really teach your kids.
I love that. Well, Julie and Annie, thank you so much for your time today. And a reminder to listeners, you can learn more at goodegginvestments.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss that Millionacres or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.